Hey everyone, and welcome. Thanks so much for tuning in. I'm your realtor, Christina Pombakian, and I am so excited to have you here today because we are going to be talking about something super important to protect your greatest asset. We're covering all the details about homeowners insurance with my special guest and good friend, Nick Ramirez from
Hello.
Goosehead Insurance. Nick, thank you so much for being here.
I'm happy to be here.
Thank you so much. Now, you have just accomplished a really great milestone, and this is part of the reason I'm excited to have you here today. You guys, Nick is the #1 insurance agent in his company in the state of California and in the top 1% of over 2,500 agents at your company, Goosehead Insurance. So you have become, over the years, one of my most trusted advisors, and it's really important to have you here to speak directly with our clients because what you provide is such an essential part of, like I said at the beginning of the video, protecting our clients' greatest assets with homeowners insurance. Now, homeowners insurance is not necessarily like the most fun topic we can talk about.
What are you talking about?
Exactly. But it is so essential. So I want to dive right in. Today we'll be talking about what is homeowners insurance, what does a standard policy cover, what does a policy not cover that you might want to consider getting coverage for, and just all the ins and outs of that kind of stuff. So let's get started.
Let's do it. Let's rock and roll.
Yes. Okay. So let's talk about when we open escrow.
Yep.
One of the first things, in fact, one of the common misconceptions that a lot of buyers have is, oh, we'll just wait to look into our homeowners insurance policy options until after we've done our inspections and we remove our contingencies. And to me, that is just a big no-no. You're one of my first phone calls right when we open escrow.
Right.
And that's because as a buyer, you really need to be doing your due diligence. It's not just limited to your physical home inspection. It also includes the insurability of the home. And in California and in LA, where there are parts of the city that are like veritable tinder boxes, and we need to think about fire insurance and et cetera, and earthquake, we really need your expertise. So tell us a little bit about your intake process. What can a client expect when it comes to looking into homeowners insurance?
Yeah, absolutely. I mean, like, intake process is always going to be light, tight, and bright. I like to have fun with my clients. As we talked about, I do have a advertising, media, marketing kind of background, and yet I found myself, almost 10 years into insurance. But when the client opens escrow, the first thing we're going to go through with insurance is just understanding who the client is, right? And understanding their assets and just kind of making sure that we're going to provide a really comprehensive kind of look as to how to protect their estate. If we're focusing only on home insurance, right, the question is, where is the home located? How big is it? What's the fire risk in general of that area? Okay, because all of those things determine what the rate will be that they pay, right? Have they filed insurance claims prior? Right? And do they have any dangerous animal breeds, right? Like if you have a pit bull or a Rottweiler, certain insurance carriers are okay with that. Certain insurance carriers are not okay with that. So we're just trying to make sure that we're kind of asking all the right questions so that way we can provide them the best comprehensive option of saying, hey, based on the information, based on the rebuild value of your home, like we talked about.
Right.
So if someone buys a home for $2 million, for example, the rebuild value of the home, which is what the insurance people look at, because if it burns down...
Like if it gets completely destroyed.
Right. If it burns down, how much does it cost to rebuild? That's what we care about, because what you're buying and selling the home for has to do with the rebuild value plus the land, right? And we cannot insure land, but we can insure physical structures.
When you say we, it's not just your company, it's just insurance companies
we in general, like we as an insurance.
Industry,
the insurance carrier, that's what they're looking, right? And obviously, like, depending on how nice the home is. So for example, a home built with imported Italian marble and like really custom showers and crown molding throughout and skylights and like really designer, if you will. The rebuild value for those homes are obviously going to be higher than homes with like granite and linoleum or those types of things. Does that make sense?
Yeah, it does.
That's really what we're looking at.
So you'll take the location, the condition, fire hazard, size, all into consideration. That will essentially help determine what the rate is.
What the rate is,
yeah.
And also like other things like, what coverages we add in, what coverages we take out, what's the deductible on the homeowner's insurance policy, right? In this market, for most homes now, we're kind of riding with a $5,000 deductible average, because the reality is your home insurance is for catastrophic problems and nothing less, right? So like, if you have a water damage problem in your home, like say your pipe breaks and does a couple $1,000s in damage to your home, and I know that sucks, but if that does happen, the first phone call is never to the insurance company. Your first phone call is to someone to help stop the damage. Right. So that could be like a plumber, a roofer, whatever it may be. Have them come out, right, and take a look at what's going on. Second phone call is to me or your agent.
Right.
And then talk with us, let us know, hey, Nick, this one happened over the weekend. The damage is about $2,500. What do you think we should do? Right? And then at that point I could say, okay, perfect, you got some quotes. Based on that, your deductible being at $5K, handle it in-house, no claim. Because remember, filing an insurance claim is like getting a speeding ticket on your auto insurance. Your rate will change based on that information, based on the claim that you file.
Right.
So we want to be mindful about when we're pulling the trigger on a claim, and always working with an agent, your agent, or me, to determine if it makes sense is always a good idea.
That's awesome. So I think this is a really good segue into what is and is not covered as part of a standard homeowner's insurance policy. Oftentimes a lot of people think, well, okay, well, something goes wrong, I'm just going to call my insurance company and it'll all be covered, but that's not really true. So let's have you break it down for us in a standard policy. What is and is not covered?
So I think the most important thing for people to understand about home insurance is that it covers sudden and accidental damage from covered things.
So sudden and accidental
Those are the two
from covered
things.
Okay.
Like the right asterisks, right?
Right.
You almost have to be kind of an attorney to and it is, because insurance is a contract and you have to understand and know how to navigate it to understand whether or not you can even have a claim to file. Right. But if it's sudden, if the damage that happens is sudden and accidental, okay, and it's covered by the following, which a standard homeowner's policy, and home insurance is fire insurance. Also, escrow calls it hazard insurance, right? So home insurance, fire insurance, hazard insurance, all the same. Okay. Fire, wind, hail, lightning, smoke damage, the weight of freezing ice, aircrafts, explosions, water damage, theft, liability.
This is the first time you've ever explained this to anybody,
first time.
I'm sure, yes.
Yeah. Okay. Shameless plug to my own podcast, The Insurance Rundown, on Apple and Spotify. And so all of those things are covered under a standard homeowner's policy. Groovy. And when I say water damage, what I meant was water damage from the inside. So like a pipe breaking, and then doing all this crazy water damage inside of your home.
Not like natural disaster.
Not flood.
Okay.
So a lot of people say, "Oh, Nick, I had a flood." I'm like, "We had a flood." Like, it worries us, but we know what you're saying. When you say, "Well, we had a flood in the house," that means you had water damage in the house. And that typically is going to be covered by your home insurance, right? Most homeowners insurance policies, most of them, cover water damage to a very high limit, okay? There are insurance policies, you got to read your policy, and most agents will disclose if the water damage limit is less than what is normal on a home insurance policy. And so that's kind of all the things that are covered under, and theft too, if I didn't say theft, but that's also covered in a standard home insurance policy.
Okay, great. So what's not covered in a standard policy?
So there's two things. What are they? What's one?
Flood, like natural hazard flooding.
Water damage from the outside, okay? No joke. And we've had this Hurricane Hillary recently, you remember that?
Right.
And there's this new fun thing called atmospheric rivers, which is a term that I don't remember hearing a long time ago.
Don't either.
But welcome to 24, where we have atmospheric rivers. Woo! And with that, when you have atmospheric rivers, and look, for the people that live at the base of a mountain, and no joke, I have a client who lives in Studio City at the base of one of the mountains there, and when you live at the base of a mountain, you should probably get flood insurance, right? Because the mountain, when it rains, and maybe it'll rain more, who knows, but...
Well, last year, my goodness.
It did.
Was unprecedented.
Unprecedented, and legit, California had some major flooding, and so if you live at the base of a mountain or near a mountain or on the side of a mountain, then you should consider flood insurance because the mountain acts as like a shovel for the water.
Oh, those hillsides just retain the water, and they can be draining for months
a while.
And months.
Yeah, and so that's why like you might want to consider flood insurance. And flood insurance, by the way, right now in California is like, I don't know, like $600 a year on average. It could be more depending on what details on the policy you might get, but like it's a no-brainer. Like if you have a lot of money or cash or equity in your home and you live, get a flood policy. So that's number one. And the other one is what's not included?
Earthquake.
Earthquake, right?
Yes. Which is a big deal. I mean, we're in California. We're in seismic territory.
Very much.
For sure.
We just had an earthquake.
We did.
Literally
we did.
5 minutes ago.
Yeah.
In the studio, we had an earthquake.
And there was one on New Year's Day.
Exactly. Yeah. And look, with what just happened recently in Japan, right? I think it was like over a 7 point something.
Yeah, it was a big one.
And we share an ocean with those folks, okay? And so it's one of those things where, and I have sold a lot of earthquake insurance recently, which I'm happy that people are recognizing. And also, we're on the heels of the 30-year anniversary to the Northridge earthquake. I think
30 years.
I think I think January 17th.
It was January, yeah.
Yeah. So and we're overdue. That I think is what a lot of people agree.
Yeah.
Earthquake insurance is not included on your home insurance policy. Not included. So and those are separate. What does an earthquake policy cost? I don't know. It depends on the size of the home. But let's just say your home is around 2,000 square feet. You could probably say that it might somewhere be between $100 and $200 a month, which is not much considering that if you have 6 figures of cash in the home or a lot of equity, it's kind of a no-brainer because the question is, if you have a lot of cash or equity into a home, is it worth $100 or $200 a month to protect all the cash in your home?
Right.
Most people would say yes.
And what are there limits that we're looking at in terms of the earthquake policy?
Yeah, so like an earthquake policy, typically the limit of the policy is the rebuild value. It's the same thing on your home insurance, okay? Now, your deductible though on earthquake is a percentage. It's not just a dollar amount.
A dollar amount, okay.
It's not like $2,500 or $5,000, right? It's like 10% or 15 or 5% of the rebuild. So say the rebuild value on your home is $500,000, right? If you get a 10% deductible, that means that the first $50,000 in damage is the homeowner's responsibility.
It's on you.
Okay, and people are like, "Holy crap!" Like, Nick, is there a policy that I can get to cover that first 50? Actually, the answer is yes. There is a new policy out there. It's a supplemental earthquake policy, and this is new. This is underwritten by Lloyd's, Lloyd's of London, so A+ rated.
Right.
Very good. And they'll give you the first $20,000 in damage to your home with no deductible. Okay.
Okay.
It might be $500 a year on average.
Right.
And the earthquake does need to be like I think a 6.0 or higher. Okay. So that being said, there are things that you can get that cover the first 20. Okay. Let's flip it and say that the home was totally damaged. I mean, like totaled.
Yeah.
Okay. If the home was totaled and $500,000 worth of structure is on the ground. Okay. The insurance carrier, if you had a 10% deductible, would give you $450,000 in cash.
Okay.
They wouldn't say, "Hey, your home is in the ground. Give us 50," because that's your deductible. They would remove that from the cash payout.
I see. Okay.
Does that make sense?
Yeah, it does.
That's kind of how that goes.
Sense. So if somebody wants a fully comprehensive homeowner's insurance policy, they would get the standard plus flood plus earthquake.
If they want to be like protected from like, and there are people who are risk averse. They just want to put their head down at night and know that no matter what the problem is, that they're covered.
Covered, right.
You know? So, and we have them sign disclosures to remind them that earthquake and flood is not covered under a standard homeowner's
I think that's
policy.
really important for people to know.
Yeah. And we definitely do that.
Yeah, that's great. So let's talk about the things inside the home. Does a standard policy cover what's inside the home?
Absolutely.
Damage to what's inside the home?
Yeah, absolutely. So like contents, right? We're talking about personal
somebody
property.
has like nice art, jewelry, family heirlooms, that kind of stuff.
Perfect. Thank you. So those things, jewelry, art, anything of high individual value, may be capped on your homeowner's insurance. So if you have, and when I present home insurance, I remind the clients that jewelry and high value art are kind of like at an asterisk.
Okay.
If you have a diamond engagement ring or a Rolex watch or a pendant or anything with ice or like I had a client who had a Monet like hanging on their house.
Wow,
and what's crazy is someone broke into their home, took the television and left the Monet.
Oh my gosh.
Right? I was
Wow.
I was like, that's insane,
Yeah.
right? You know,
That's like amazing for the homeowner.
And then I
that
asked them,
Monet
I was like,
wasn't taken.
do you even have that insured?
Oh my
and they're
gosh.
like, no. And I was like,
Oh.
okay, you know, so it's like, but yeah, so if you have high value jewelry, art, wine, even handbags sometimes can be capped. So you want to be mindful of those types of things. And there is handbag insurance. Like you can get,
good to know.
yeah, in case inquiring minds. There's handbag insurance, there's rings, jewelry stuff, all that type of stuff is something that you can get as a separate policy, right? And it doesn't have to be included, but on a homeowner's insurance policy, all those things, right? Like your furniture and clothing and tables, desks, chairs, in the event of like a home invasion kind of a situation, all that stuff is covered. Also in a fire, right? Those things are also covered. It's important to make sure though that like when you buy a home, and you want to also advise your clients this too, take pictures of your stuff after you move in. So you know when the house becomes a home. And by that I mean like you've moved in all your stuff,
Right.
you have all the beautiful artwork and stuff set up. Take pictures of your stuff. And you should, and we do try to remind our clients, because if it burns down, then you have to work with the adjuster. And the adjuster is going to say, Christina, we're so sorry for what happened. It's terrible. What did you have inside?
Right.
If you're not prepared to answer that question, it's going to be a very difficult conversation with the adjuster, because the adjuster is the person who's going to write the check.
They're
not
going
me.
to be looking for proof, essentially,
Proof.
of what you had.
Of what you
that
had
is
inside.
now lost.
Yeah, and if
Right.
you don't have proof, then it just makes for a very challenging conversation.
Right.
You know, and quite frankly, a really shitty claims experience. And and insurance is already kind of shitty generally. So we don't want to add to that.
Right.
We want to try to do what we can to help make sure that if you do end up filing a claim, that it is, as smooth as it can be.
But like just the emotional toll. I mean, my goodness, if you've just lost your home or some valuable contents in your home, and not just monetarily, but also sentimental value, it's just better to document all that stuff, take the pictures, have it, and then, like you said, it'll just be a less shitty experience.
Less shitty experience. And look, keep it in your iPhone, keep it on your cloud storage, whatever, and just have it. Likely you will never need to use it, but if you need to, you know that it's there.
Yeah, absolutely. I think that's really important, and I'm so glad that you advise the clients of that.
Yep.
My family lived in Porter Ranch, and as you know, high fire area.
Yep.
And there was, multiple years where the fires were coming down right behind the hillside, and fortunately, everything in the home and the home itself was fine, but we did have everything documented just in case. So from personal experience, I know that it gives you peace of mind when things seem to be falling apart around you.
Yeah.
At least if you have that done, you'll know that if you do need to file a claim, it'll be that much
You'll be
easier.
all right. Yeah, exactly right.
Exactly.
Yeah.
Speaking of fires,
Yeah.
high fire zones everywhere. Los Angeles County, Ventura County. Insurance companies
all
have
over the place.
All over the place.
Yeah.
There was big news when State Farm left California.
Yeah.
Not that they're not issuing new policies, they're not ditching the policies that they've already insured,
Correct.
but with such a huge name as State Farm leaving the state and other insurers following suit, where has that left California homeowners in terms of fire insurance?
Yeah, I mean, it's definitely created a pinch in terms of like the available carriers to write. And I think this is a really good place to kind of talk about the emergence of what we refer to in the business as an excess line or a surplus lines carrier. So there are a lot of different types of insurance companies in the state of California. Okay, some of which are what we refer to as admitted companies,
Okay.
like State Farm, Farmers, Allstate, Nationwide, Travelers, all the names that you probably know because they spend millions of dollars on advertising.
Right.
Okay. And then you have a lot of other types of insurance companies that are still A-rated. Okay, so we're talking like SageSure and Heritage and Lloyd's of London and companies like that, right? That maybe you haven't necessarily heard of, but are in fact A-rated companies. The disclosure with those types of carriers is that year over year, they reserve the right to, doesn't mean that they will, but they reserve the right to increase your insurance renewal premium more than 7%. And they don't have to ask for permission. So
Whereas other companies do need to ask
where they
for
have
permission.
to ask for, these guys don't, right?
And they're asking permission from who? The
from
insurance
the insurance commissioner in the
Okay.
state of California,
Okay.
right? So, and because part of the reason why we're in this mess is because of the way that the governing body for insurance in California maybe didn't do such a great job in terms of managing the insurance markets in California, right? Florida is going through similar situations, Texas kind of too. Is that you have these carriers that are coming in saying, well, we'll happily write insurance, and the contract 9 times out of 10 is exactly the same as a homeowner's policy. They're going to cover all the things we just discussed, and they're going to take care of you sometimes better than the fair plan. But the reality is there's a disclosure that you have to sign to explain to people that this policy that you're buying is a surplus company, and it means that they just reserve the right year over year to to change their rates on renewal. They can't do it in the middle of the term. So if you buy for $5,000 one year, they're not going to change it in the middle, but it could go from 5 to 7. It's possible,
Right.
but it could go from 5 to 5,100, right? And that's fine. But so that's the emergence of what's kind of come into California, and that's great. It's a welcoming thing that they're here, because if they weren't, then everyone would be going to the California Fair Plan.
Okay, which is a great segue to the California Fair Plan.
Yes.
Talk about that.
Yeah. So the California Fair Plan is designed for people. It's last ditch insurance. California set this up to be a place where pretty much no matter where you live, you can get fire insurance. Okay. That doesn't mean like now.
And when you're saying, I'm sorry, Andrew, when you're
Yeah.
saying fire insurance, again, just to reiterate, that's
home insurance.
homeowners insurance.
Home insurance.
Right,
yeah.
not just fire.
But
Right.
the Fair Plan, and I have a separate YouTube video about talking about this specific policy.
Okay.
But the Fair Plan covers only, and so it's limited, so you have to get a second policy to cover the things that the Fair Plan doesn't.
Okay.
Fair Plan does cover fire, right? And it's fire, wind, hail, lightning, and smoke. Damage. That's it.
That's it. Okay.
That's it. There's nothing else. So water damage, theft, and any liability, like any injuries or anything like that happen on the property, are not covered by Fair Plan.
So you need to get a supplemental.
So you need to get a supplemental policy to cover that, right? And the supplemental policy could be a couple $1,000, and Fair Plan, whatever that number is, right? And it, depending on how big the home is and where it's located, will determine what that rate is.
Got it.
And the Fair Plan's what we call TIV, total insurer value, caps out at $3 million. Okay, so the rebuild value of the home, including the contents inside the home, the money to live elsewhere if you're displaced, what's referred to as loss of use, because you lost the ability to use your home.
Right.
All of those things, including debris removal and building code upgrade, which is like to rebuild the home to current building code, all of that needs to be under the $3 million mark.
And if it's not,
you can still get Fair Plan, but the settlement that'll happen at that point will mean ACV coverage, actual cash value. What that means is, when your car is totaled, they don't give you the same amount that you bought it for.
right.
It's a depreciated payout. The Fair Plan turns to ACV if the amount of the insurance is more than $3 million.
Okay.
So you want to be really careful about and that's really for homes that are like north of like 6,000 square feet. you know? So if your home is under 6,000 square feet, you shouldn't really have any issues. It's where you have homes that are north of 6,000 square feet, then that could become a potential issue. So you got to be aware of that.
Which, I mean, in areas that are high fire zones like, you know, Malibu or the Palisades or Topanga, you know, there are significantly sized estates over there with homes well over 6,000 square feet in areas that are very high fire.
And those, I mean, like, look, we just did, I just wrote a policy last week where the rebuild value, and it was in Beverly Hills, on coming up the mountain, like not like in the flatlands, but just kind of coming up a little bit. And the rebuild value of the home is $10 million. Wow. Okay, the market value is probably around $25 million. So the buy-ins, you know, the home is worth about $25 million, and the insurance premium on that was extremely high because the FAIR plan can't insure a home where the rebuild value is $10 million. You know, it's just, at that point, it just doesn't make sense. So they ended up having to go to surplus lines, like I was telling you about.
Right.
Take a wild guess on how much you think that policy costs.
I don't even want to.
You want to know?
Yeah.
180 grand.
Wow.
180 grand.
Well, I mean, for a home of that size.
Of 25 million.
I mean, come on.
You know?
Yeah.
But like, it's like you can't complain about the gas when you buy a Bentley.
Right, exactly. You kind of...
But like, you know, and we also have options. I mean, it's important to know that if you're ever in a situation where either you of your clients or anyone else, or you, and the premiums, and it's true, but like, we have premium finance is now an important thing that's come out, okay? So like, for example, if someone has an insurance policy that got renewed, I just had another client and the renewal went from like 18,000 last year to like 25 this year. Again,
that's a big jump, yeah.
It's a big jump, but it's on the surplus line, so they have the right to do it, right? But no one else wants to write in that area, and it's too big for FAIR plan. They're kind of pinched, right? So what they opted for was finance. So so there's a company out there that we work with that essentially will, for a small finance fee, pay the entire year's premium on your behalf, and then you can go monthly on it.
Oh, got it. That seems like a great feature for people who don't want to shell out
a lot of money all at one time. So that 180 premium I was telling you about a few moments ago, they went premium finance route too.
Oh, they did.
You know, because I mean, like 180 on or whatever, even large amounts. If you feel like you're at a point where you know this is the policy you want, but you can't or don't want to pay for the whole thing up front, you can finance it out, and so that would mean that you'd only have to do like 25% down, and then the rest will be pushed out over 10 months.
What are the rates on that kind of stuff?
No, I mean, like, not bad. I mean, like, I think I saw it cost maybe an extra $1,200 a year to spread out a $25,000 policy.
Oh,
it wasn't egregious, but the reality is that, like, you know, it is what it is, you know. So, and we don't add any extra to it. So it's whatever they do, that's what we pass to the client. And for me, we don't charge broker fees, we don't charge any extra policy fees, and most of the time there's no cancel fees. The thing to be aware of with the, you know, those surplus lines policies is that there is something called a minimum earned premium, which means if you cancel the policy within the first 3 months, they're not going to give you all your money back. Right? So if you wait until 3 months and then cancel, then it's pro rata. They'll give you your money back.
Okay,
you know?
I see.
So it's just important to know, like, some carriers do have that minimum earned, and as a consumer, you want to be aware of that and ask, hey, is there a minimum earned premium? If I cancel this early, you know, what does that look like?
Yeah,
you know, and things of that nature.
Yeah, you're just a wealth of information. I know one of the other reasons that I like to get my clients in touch with you is that you are an insurance broker. So what you can do is actually shop around to various insurance carriers and offer the best, most customized policy for the client versus if a homeowner were to go just to a State Farm or just to Farmers or Geico, you know, whatever the case may be, those agents can only offer their product.
Correct.
So I feel like you're helping put more power into the client's hands by using your expertise to reach out to your vast network of insurance carriers and really trying to find the most customized solution.
Yeah,
for them.
we have more arrows in our quiver, is what I like to say.
Yeah.
And also it gets nice when you work with one person or one team, and they're going to do the shopping, and then you can focus on all the other things that you need to do.
Right.
All
the fun stuff.
All the fun stuff that you help them with, like inspections and different contingency periods and negotiating, right? You know, and things of that nature. Like if I look and I see, wow, that roof looks really dated, I might tell them, or I might tell you, like, hey, that roof is really old, it needs to be replaced. Maybe you can work to get a credit against the sale, right? To be able to like say, hey, look, we're gonna need a $15K credit on the sale because your roof is 40 years old.
Right.
And that's just not okay, because you have to remember that after the insurance has been issued, 9 times out of 10, within 60 days, there will be a home inspection by the insurance company. And they're gonna, and most of the time they're not gonna go inside, but they will walk around the exterior premise. They just wanna make sure that like what's on the application is what is in reality.
Right, it matches up.
They wanna kind of match it to make sure, and if we insured it on the app for $500,000, that the rebuild value is in that neighborhood, right? And not $500,000 and the rebuild value is actually $1 million. You know, so that happens, and by law that does happen within 60 days. So
and what happens if a discrepancy is determined?
I'm real glad you asked. If there's a discrepancy, and we talk about this too, and I send out these notices, I'm like, you're going to go through inspection. If there's going to be turbulence that may happen, and we'll know within 60 days. Okay. Some of those matters are things that we can cure, like the most common offenders that happen in the first 60 days, trees overhanging in the home, over the home.
Like above the roof line or the...
Yeah, and this week we're supposed to have some really strong winds. And that's another thing that California has is strong wind, right? In the Santa Anas and things of that nature. And so if we have strong wind, branch snaps off, falls on the home, causes lots of damage, that's covered by your home insurance. Right? And so, but the carriers see that as a hazard, and they're like, well, your job as the homeowner is to help them keep their rates down by doing things like trimming trees back, right?
Try to mitigate those kinds of risks before they actually become problematic.
Yeah, and so like when you're looking at a home and you're walking and you're looking up and you're saying, wow, there's trees overhanging on the home, that might be a thing you tell the client, like, hey, don't be surprised on the insurance inspection down the road that this might be a thing you might need to cut back. And that
my home inspector also calls those out.
Yeah,
you know,
and that's great. I mean, I'm glad that they do, and that's great because it sets the expectation properly for the client, that they're not surprised, right? Other things like, dogs, maybe they didn't disclose that they're dogs, and then there are, that could be an issue. And then the other one is just generally the roof. Right? And in this market where we're at, and we refer to this as a hard market, it is because so many carriers have shut down, and how do I put it? The vibe of the carriers that are still riding right now are not so hot, right? They're kind of cranky, not really happy, and so when they do an inspection and they see that the roof looks like it's like towards the end of the life, they may tell you, hey, that's not kosher, you need to replace the roof, or we're going to cancel your policy.
Wow.
Right? And these things do happen. Yeah. And so when you have a home inspector saying, oh, this roof has a few years of life on it left, you got to be, you got to really be prepared to know that that's cool that they said that, but they're not the ones insuring the home.
Right.
Because when the rain happens, of course, naturally, if it doesn't do what it's supposed to, and then there's water damage that happens from a bad roof, on the inside of the home, likely covered by the insurance, they want to try to mitigate that claim before it happens.
Right. So let's also talk about, now that we're actually talking about what the homeowner needs to do to kind of mitigate certain risks, let's touch briefly on like maintenance issues versus catastrophic type stuff, because inevitably, I'm sure you've gotten phone calls of, oh, hey, Nick, there's this leak. This pipe has been leaking. I'd just like to file a claim through my insurance. And then what do you tell them?
Well, it's like, I'm like, are you sitting down?
Oh, boy.
Do you have an alcoholic beverage nearby?
Oh, my gosh.
No, I'm kidding. But the thing about insurance is the function of insurance, like we talked about earlier, is to cover sudden and accidental damage to the home from covered things, being fire, wind, hail, all down the list. Okay. When someone has like a water leak that's been going on for a long period of time, that's likely going to be declined by the insurance carrier, right?
So let's categorize that as like, say, negligence, for example. Like if you knew that it was leaking, for example, or it was broken and you didn't do anything about it until it just became unbearable, that would be considered negligence and like lack of proper maintenance.
Proper maintenance,
Right.
and a dead giveaway when something's been leaking for a long period of time. What grows when you have water leakage over a long period of time?
Mold.
Mold.
4-letter word when it comes to real estate. That's for sure.
Mold.
Yeah.
And mold. If there's mold on damage or anything like that, or on the property, that's a dead giveaway to be like, look, this has been going on for quite some
long
time.
time. Yeah.
Right. And therefore, Mr. or Mrs. Homeowner, declined. Right. Because that's not sudden. It's not a sudden thing, and that falls under maintenance. So look, keeping up the home with like proper, like a roof, a shingle roof should be replaced every 10 years, 15 years max. Okay. And you want to save up for that, CapEx, right? You want to be able to know budgeting every single month.
Capital expenditures.
Capital expenditures, which is a budget that you want to save for, such that, you know, whatever $10,000 is divided over 10 years, right? Whatever that number is, that you, when in 10 years, you're ready to get that new roof. And also, a lot of insurance carriers will give you a preferred rate and a lower rate if you have a new roof, right?
Nice.
So that's great. So, but making sure that the roof is in good condition. Plumbing is a huge one. If you're, you know, what is it, we in 24, your plumbing should be copper by now, okay? If it's not, then you should invest or work with a plumber to get that upgraded, because that's kind of what the standard is now. It's the copper standard. And then HVAC and air conditioning and stuff, you want to make sure that, and the water heater, right? That's another one, you know, like if your water heater is like making weird sounds and you're like, dude, you know, please don't wait for it to rupture and then file an insurance claim, because remember, insurance claim equals speeding ticket equals your rate will go up later. So you really want to be mindful about not waiting for those things. But if you are, you know, like I had a guy call me once and he was like, Nick, I'm ready to file my claim. My roof is ready to be replaced. And I was like, no,
oh
man.
boy.
Like,
oh no.
That's you, boo-boo. Like that's not something that's covered by insurance,
Sure,
right?
he was
You know,
not
like,
very happy to hear that.
well, he was. I mean,
man.
but he. I think he was wishing. You know, I think he knew.
He's like, I'm going to try.
He's like, I'm going to try to slide this by Nick and see if this happens. And I was like,
get a new roof
I was
out
like,
of this insurance
rejected.
policy. Oh no.
Yeah. So, but yeah. So as long as you're like, look, and that's the job of the homeowner. The homeowner's job is to maintain the property. As long as they maintain the property with the things that we talked about, the roof, the electrical, is another thing.
Yeah, the main systems of the home.
If you do an inspection and you see a Zinsco electrical panel, like that's just,
those get called out so often.
Yeah, I mean like, and why? The reason why is because they are faulty. And they cause fires, right? And so like the insurance carriers, all of them know this. And I think now, and there's a few other companies too. It's not just Zinsco. There's a few other panels out there that are just known as really bad. And you tend to find them on homes built before 1960, right? You know, the homes that are built after 1960, you typically won't find it. But you want to make sure that the electrical has been upgraded, whatever it may be, because if there's a sudden fire, that's covered by the home insurance. So they just want to make sure that, you know, all of those things are in good working order.
Right.
Yeah.
Right. Yeah, I think one of the keys about home ownership is that it's very exciting when you're buying a home, especially if it's your first one, or it could be your third, fourth, fifth, it doesn't matter. It is a responsibility also, and you want to do everything that you possibly can do to protect this asset. Most people save up, you know, it's a life savings. They're saved for many years. It's not only their money, but sometimes their parents help them buy them. I mean, this is hard-earned money that's going into this property, and your work doesn't stop when you close escrow. It actually starts in a whole different way.
Yeah,
you know, now you have this asset to take care of that is also taking care of you.
Yeah.
You know, in so many ways.
And you know, speaking of, like, you know, you're saying a lot of people save up a lot of money over a long period of time to be able to afford this. And what a lot of people do in this market, and as it does happen, is they may say, well, we're going to buy this home, but then we're going to renovate it, right? We're going to renovate this home, and we're going to renovate it for, like, I don't know, like 4 months or 6 months or whatever, or maybe longer. Sometimes shorter.
It does take longer,
Sometimes it's just like paint and stuff, and it'll be done in a few weeks. But it's really important to know that, like, if in the first 60 days, because that's when the inspection happens, okay? One of the things you asked earlier is, like, you know, what are some of the potential problems that can come out of that. A big one is people get home insurance not realizing that the home insurance carrier expects that that homeowner will be and occupying that house no later than 60 days. Okay? If they're not there and they do their inspection and they're like, this home is vacant under renovation, cancel. Because the risk of a home that's vacant under renovation is very different from a home that's occupied.
So is that something that would need to be disclosed to the insurance carrier
Yes.
when a purchaser is buying a home? Like,
Yes.
hey, this is a fixer. We're planning on improving it.
Right.
We're not going to be moving in immediately.
Yes.
It'll probably take 3, 4, 6, whatever it
Yes.
is. Okay.
You want to disclose that information to the insurance agent because if you don't, and I mean, look, most of the time we see these online listings. If it's got purple carpet,
which I've seen.
Which I've seen,
I've
yep.
also seen magenta.
magenta. I've seen Tiffany green. I've seen a lot of different things, and it's kind of like a dead giveaway. When I see a home that looks like it hasn't been flipped yet or anything like that, or renovated, I'm going to lean in a little bit and be like, all right, so this home is nice. Are you going to be renovating it before you move in? And most of the time it's like, oh yeah, we're going to do it for like a little while. You want to let us know because there are solutions that we can work with and create to kind of give you a temporary policy that covers the home during vacant under renovation.
Perfect.
And then when you move in, we can turn around and write you a standard home.
Like a permanent.
Owner occupied
Got
home. Because homeowners means owner occupied. If the occupancy is vacant under renovation, then you want to change it out. You want to get something that and will the rate be higher? Yes. Yes, it will. But it's temporary.
The rate will be higher for the renovation portion.
Yeah,
of
because the
home.
risk is higher. Because
Right.
when you have contractors coming in and out of the home, sometimes contractors, have a paint bucket that has fumes that could light on fire, and you know what I mean. Like things happen, so the risk of a home vacant under reno is higher, and therefore the rate is higher. But it's temporary until the homeowner is moved in.
Yeah, and better to just have that coverage than all of a sudden be canceled.
Correct, because
Right.
if the carrier on the inspection finds out, or during the claim, they come to find out that in their discovery, and they will do a big investigation, right? And they have fraud units. It's a thing. Like they have teams of insurance inspectors that will look and determine whether or not this home was even vacant, or even occupied.
Right.
And if they feel and they deem that no, this home was vacant, it was under renovation, and that's not what this application states, then they have the right to battle you on the claim. And the reality is these insurance carriers have more money than you do.
This is true.
And they
Yeah.
could probably fight longer in court than you can.
Yeah.
So it's not worth going down that road.
Right.
You know what I mean?
Right, yeah. But it's also good that you ask the question too. Like you as the agent are doing your diligence, looking at the photos of the home, asking all the right questions, because part of your job is also to protect your client and make sure that they're getting the proper insurance that they need for the goals that they
For whatever
have.
it is that they're doing.
Yeah.
And if they're going to move in within 30 days or 60 days, right? Groovy, And if they're going to take longer because they're coming out of state or whatever it may be, those things do happen, and they're going to need more time. Okay, I can work with underwriting to let them know, hey, they're on their way, like they're coming,
Right,
don't cancel, like.
But it's
and
just
that,
a matter of disclosure, it seems. Like just be upfront with your plans.
Yeah, and if you feel like you're not going to be, like say you buy a home and you're not sure whether you're going to be there in 60 days or not or less, then it's okay. Then we'll tell you like, hey, look, if you get a notice in the mail for a cancellation because the home looks vacant, just don't be surprised.
Right.
Like because that's the thing, and at least we can help set your expectation.
Yeah.
Yeah.
Well, so much of what we do is about setting expectations properly. People can make sense and deal with a lot of things as long as they know what to expect. It's those bad surprises that we try to avoid. The good surprises are great. It's the bad surprises that we do everything that we possibly can to get ahead of.
Right, and it's because we want to try to give them the best experience possible. And obviously clients who work with you come to enjoy that because that's the type of experience that you're delivering, which is amazing.
Thank you.
And that's why you've had all the success that you've had, is because you can set those expectations and you can make sure that you're coaching and guiding them throughout that process, right? And also talking, one of the intro emails sometimes that you send, you talk about running a clue, right? You remember that?
So yes, the clue report.
Can you tell our lovely audience here, like, what is it that email, what are you trying to get at when you send that out?
Yeah, so the CLUE stands for Comprehensive Loss Underwriting Exchange.
Yes.
Right? So the reason that I don't think a lot of agents do this necessarily, but the main reason why I like to ask you to run a CLUE is because it will give me and my buyers some insight as to the history of insurance claims on the property.
Right.
I recently did a video with one of my colleagues who's a real estate attorney, and she does a lot of like disclosure litigation type cases. And sometimes sellers just forget on the disclosures. If they've been in the home for 20, 30, 40 years, they kind of forget what has happened even in the last few years. So as part of our diligence, I ask you, hey, can you look into the historical claims of this home? Was there, theft, fire, water, whatever the case was? And it has happened on several occasions that sure enough, you found something, and I get that call or that email from you like, hey, there was a water loss a few years ago, and it didn't show up on the transfer disclosure statement from the seller. So now I have some information that either maybe the listing agent is not aware of, that maybe the seller forgot to disclose, that I can go to my clients about and say, hey, look, we found out that there was a water leak. And now I can go back to that listing agent and the seller and say, hey, look, we found that 2 years ago there was a $10,000 loss for water.
Yeah.
What happened? Was there mold? How was it fixed? Do you have the paperwork that is associated with the repairs? Do you go through insurance? So many questions.
All the questions.
All of the questions, and it's really important for a buyer to know. So that clue is really essential.
And the loss report is something that, like, we as agents, like, if you're under contract, and I found out that there are some captive agents, I won't name names, but they won't disclose that information to the buyer. They're like, that's not their information. I'm like, but they're in contract to buy that house. They have every right to know about the loss that happened from the seller. They have every right to know about that.
Right.
So why would you not tell them? But we always do. And if I find it, I'll be like, hey, this happened. And a lot of times all I can find is the loss amount, the date that it happened, and then who was the carrier. Maybe the policy number. But details and circumstances surrounding the claim, I don't really have. Okay. It may say water, it may say fire, it may be smoke. I don't know. But still, that, like, you want to make sure that we're following back up with those people to explain what happened.
Right. Okay.
If there is a loss on a property and your buyers are buying a home and the seller had a loss, the question is, Nick, do your buyers get penalized for a loss they didn't file? The answer is, it depends on the carrier, right? Most of the time, the answer is no. Prior owner losses are not chargeable to the buyer.
To the buyer, right?
Yeah, it's not chargeable. So they don't get penalized for a claim they didn't file. There are carriers, though, that will just automatically raise the premium because that home had a loss already. And when you have one loss, the likelihood of another one happening down the road is significantly higher. Right? So the rate can go up technically in a way that is penalizing the borrower or the buyer.
Does it depend on the type of loss? Like if it's, for example, fire or plumbing leak or theft, for example?
Yeah, so it does depend on that. And also depends on the loss amount too. So if it was a loss amount that was like, $5,000, that could, it's an easier thing, kind of a thing. But also, like, why are you filing a claim for $5,000? It's like also like, that shouldn't have happened anyway. But if it's more than $50,000, that will set off some additional red flags to underwriting. They're going to want to know what happened, how was it mitigated, et cetera, right? And so that's why it's good to work with someone who is, and certain carriers, by the way, when they see that type of loss, they may just say, look, you know what, this whole place is ineligible, we don't want to write it. AAA may come back and say, you know what, we don't want to write this at all. Like, good luck, right? Like, va con Dios. It's not us, right? Not us. We're out, right? And that happens. A lot of carriers are doing that now. And so, but we have carriers that will, even with that information, they'll forgive the loss. They won't charge the loss to the buyer, and we can get around it. But it's still something that, you want to be aware of and mitigate if there is an issue.
Right, at least just get in front of it and know. I mean, there is no perfect home. There's always something will come up, something is wrong, something has been wrong, something has been replaced. But what I tell my home buyers is, let's just find out as much as we can.
Right.
Let's do our diligence. So not just home inspections, not just physical, but also insurability. Because especially if you're getting a loan, you're not going to be able to get that loan until you can prove to the lender that you have a homeowner's insurance policy in place also. I had a neighbor once who had purchased her condo all cash and forgot to get a homeowner's insurance policy. And sure enough, there was a catastrophic sudden water event. Yeah, and she was
in a condo, right? Yeah.
Let's talk about condos. We've talked all about
my favorite.
Your favorite. Yay. Condos and townhomes.
Yes,
We've been talking all about like the freestanding homes. But a lot of our clients buy condos and townhomes. They also need insurance. The condo or homeowners associations of the condo complexes have their own insurance policies.
Right.
But that doesn't mean that the homeowner should not have their own policy to protect them. So let's talk about the HO6.
The HO6. Dun, dun, dun.
Dun, dun, dun. Let's do it.
HO6 unit owners, the first thing I think that everyone needs to know is that I don't care if the lender if you're getting a loan, and often how many times if I had a nickel, when the loan officer or the lending folks say, okay, you're getting a loan with us, but there's already walls in coverage, so you don't need your own unit owner's policy. The master HOA is enough for us. It might be enough for the loan people, but it not enough for the buyer.
For the consumer,
for the client, for the person who's buying the unit. Because what won't be covered and what they don't care about, because your lender people, all they care about is their requirements, not your life. Right? So if you, anytime you hear, even yourself or anybody, oh, you don't need it, you should always have your own HO6 unit owner's policy if you're buying a condo. And you can modify the coverage based on what the master policy has, but you should never just omit it in general.
Right.
So that's really important. What does the condo insurance policy cover?
Yes,
so
that was my next question.
That was the next question.
You read my mind.
So a condo insurance policy covers just a few things, right? So and we call it a walls-in policy. So when we say walls-in, what we mean by is that as a unit owner, your policy is going to cover the flooring, the cabinets, the countertops, and the lighting fixtures in the unit. That's what your policy covers. It also covers personal belongings, so personal property, furniture, clothing, tables, desks, chairs, loss of use. If you're just, you lose the ability to use your home because of a claim, now you need to live somewhere else.
Right.
And your insurance covers that. Okay. Liability, slip or fall, anyone gets hurt, or you throw a razor one day and you have a balcony and someone falls off the balcony.
Heaven forbid.
I don't know. Those things happen, right?
Right.
All those things are covered under unit owner's condo insurance policy. Also, something called loss assessment. Okay, so if say there's a fire in a common area of the HOA, well, the HOA is going to take the amount of damage. They're going to divide it by the number of unit owners that are in the building, and then they're going to serve you your portion of that loss via something called loss assessment. And so that's like for fire damage, and your insurance policy will cover loss assessment. It does not cover special assessments. So can you tell people what a special assessment is?
Yes,
okay.
I certainly can. So a special assessment is a fee that is charged to the homeowners within a homeowners association that is in addition to the regular monthly HOA dues. Okay, so your normal HOA dues may cover common area maintenance, it may cover trash, in some cases it may cover water, in some cases it may cover earthquake insurance. There isn't like a blanket coverage of what the HOA dues are for, but that'll give you a ballpark idea. When the HOA dues are not enough or insufficient to cover other repairs that the community needs, for example, a new roof, which is very, very common.
Yep.
You know, new roof on the buildings, or new plumbing, or paving some part of the driveway. If there aren't enough funds in the HOA dues that are collected, that is when the homeowners are assessed an additional fee on top of the HOA dues that don't run forever. You know, there is a budget. If the roof replacement is going to be costing, you know, $100,000 for however many roofs, they divide it by the homeowners, and those fees are collected in addition to the HOA dues for a period of 6 months, a year, whatever it may be. And then once that expense, once that cost is fulfilled, then the special assessment drops.
Is done. And special assessments are not covered by home insurance, right? So loss assessment has to do with a fire happening in the HOA. Okay. But special assessments, it's like that's a maintenance matter. And we, as we talked about, maintenance is not a function of insurance. Maintenance is the job of the homeowner and or the HOA.
Right.
Not covered. Okay.
Which, like, as a side note, I'll probably need to do another video of this. We're going to talk about HOAs and how they're funded, and if they're sufficiently funded, and what you need to look for when you are reading the HOA.
Yeah, that's a huge thing, because if they're not properly funded, you could get yourself into, I would imagine, a lot of debt. Because
if you don't have the cash on hand,
if you don't have the cash on hand, and if they are needing to do a bunch of special assessments, you know, when was the last special assessment happen? What was the rate? You know, all those types of questions. What was it for? And what's the overall health of the HOA? I think in a letter grade kind of a situation, I think is huge. Yeah, absolutely. But so your home insurance or condo insurance policy covers all of those things, right? It doesn't cover earthquake damage, just like a homeowner's policy. Condo insurance, HO6. Homeowners, by the way, HO3. Condo insurance, HO6. Okay, so just to understand those two things. Earthquake is always separate, and flood insurance, in the event that you buy a condo in a high-risk flood zone, also not covered.
Right.
Okay. That's much more rare to have flood zone condos. You tend to see that more in like Northern California, like up in San Francisco and Oakland and certain areas up there, but not so much down here in Southern California.
Let's touch on the earthquake insurance for condos, because it was literally just earlier this week you and I had this conversation. I was looking into a condo that has an HOA that wherein the dues do cover earthquake insurance. And you brought up a really important point to me. You were saying, hey, you should actually look at the master policy, because you might want to consider getting additional earthquake coverage. So explain that a little bit more.
It's kind of like we're playing Tetris almost, right? You know, it's a puzzle. So you have, if you live in a condo in an HOA, and the HOA is lucky enough to have a master earthquake policy.
Because not a lot of them do.
Not a lot of them do, because they ain't cheap, right? They ain't cheap.
Yeah, the HOA on this place was $1,400 a month.
Exactly.
Which is high for the
Which is high. I mean, like normally they're like what, 4, 5, 6, 700,
right around
something?
like 500, 600. Yeah.
And that's normal. But if the master HOA has a master earthquake policy, that often would be, you know, several $1 million, because it's the whole entire structure of the entire building. Right. Not the walls in, but the entire thing, the whole structure. So a master earthquake policy will often be, you know, a 15% deductible on whatever millions of dollars is to cover the entire exoskeleton of the HOA. Okay. So if it's, you know, and I don't have a calculator in front of me, but if it's 15% of, you know, several $1 million, then you have to take that number divided by the number of unit owners, and then that'll tell you the amount of loss assessment earthquake exposure each individual unit owner has. Because, you know, if you were to say, oh, Nick, well, I don't need earthquake, the master has it. It's like, okay, well, go look and tell me what the deductible is. And then they look and they're like, okay, it shows a deductible of $300,000 because it's 10, whatever the number is, right? Like, all right, well, 300,000. And how many unit owners are there? And they're like, well, 10. I'm like, okay, well then your exposure individually as a unit owner is $30,000
right.
On you before the master policy even starts. See what I mean?
Yeah.
So like that's why earthquake insurance, HO6 condo, is kind of a no-brainer. And like we write our preferred carrier that we write with earthquake is Palomar, and their rates are fantastic. You can get a condo earthquake for, I don't know, $60, $100 a month. You know?
Wow. Yeah.
Pretty low considering.
I mean, considering we're living in California and earthquakes are
and
a thing here.
they're a thing, and it's kind of like we're just waiting for the big one, and like a little, you know, that emoji with the
with the teeth. Yeah.
that's where we'll add that into the video, right?
Yeah,
you know,
exactly.
kind of thing. But like, even if you were to say, well, Nick, you know, I still am okay with, I don't care about, you know, I'll absorb the $30,000 if it happens, and I don't need earthquake condo. I don't want it because I don't see value in spending or investing $50 a month or $100 a month on condo earthquake. Other things that you need to consider that are not covered as well is all the belongings inside your home damaged. That's on you. Loss of use, so a place to live because you've been displaced. If your building gets red tagged, that's also on you.
Right.
And then then there's the loss assessment.
Yeah.
You know, so there's enough reasons why I think like most unit owners in a condo should absolutely have their own condo earthquake policy.
Makes sense.
You know what I mean? And like going back to like the regular HO6, not earthquake. You know, the most common problem, and man, when these problems happen in condos, they can take years as far as claims are concerned, and a lot of times it's plumbing related matters. So and so when you're buying a condo, I think really what's really important is asking them for loss runs, asking the master HOA to provide you loss runs. A loss run is a document that shows all of the claims that have been filed, and you can say for 5 years. So if you want a loss run doc for 5 years, it'll show you all the claims that have been filed in 5. If there's a litany of claims, you might, you know, you gotta be careful with that because you're stepping into a place that hopefully has been like mitigated and cleaned up, so it's like it won't happen again. But like condos are sometimes often telling the unit owner saying, oh, well, this problem is on you, but the pipe that broke is inside the wall.
Right, like between like 2 units, you know.
If I'm living in a condo, right, and a pipe breaks that's inside the wall, there's no way for me to view it, no way for me to manage it or maintain it. How am I supposed to be responsible for something I can't even see?
Right. That's
ridiculous. And I've had a lot of carriers in situations, HOAs, where they're like, oh, you just file the claim on yours. And they try to pawn off that situation to the unit owner, and then the unit owner calls me to try to file the claim, and I'm like, oh no, honey, no, it's not going to work like that.
Yeah.
You know, like you need to push back because that's fucking ridiculous.
Yeah.
You know,
Yeah.
like there it is. There's the first
There-
F-bomb.
there's the first
It took a
F-bomb
minute,
of the
but.
video. I was wondering when it was going to drop.
It's like, so we don't want to have our clients be taken advantage of by an HOA person who doesn't know what they're talking about.
Right.
You know, it's like, no, that was inside the walls. No way for us to maintain it.
Right.
The HOA needs to take care of that. Right.
Absolutely.
And then we have to push back. But like, say for example, I don't know, you have a cat or a dog that you left in the unit, and the dog or cat was like walking somewhere and got on top of the thing and then turned on the water, and the water was like overflowing,
leaking,
you know
right.
what I mean, and like caused all this water damage in your unit over the course of like 6 hours, kind of a situation. That would be covered by your condo policy. And look, we always want to say that like your insurance, like how much insurance walls in do you get? Right? The minimum you always want to get is a minimum of $40 a square foot. Okay? Never less than that because okay?
Just don't.
Just listen to me. Minimum $40 a foot. So if you're buying a unit that's 1,000 square feet, right, you want to make sure to at least have $40,000 of dwelling coverage, which is the walls in, which is the flooring, the cabinets, the countertops, and the lighting fixtures.
Right.
Okay. You can go higher than that, and it's often recommended that you do, right? Somewhere between 40,000 minimum, maybe up to 100,000, depending on how nice it is inside.
Right.
Right? You know, if you have like really beautiful custom floors and like, custom countertops, and like, the the smooth closing, like
the soft closed drawers.
The soft closed drawers.
Yeah, of course.
Clearly, this is like a nice kind of thing. Then you want to have better coverage for those types of things.
Right.
Yeah, exactly. Yeah. So, and condo insurance right now in Cali is is a total. We talked about this. PETA. It's kind of a pain in the ass, and the reason why is because a lot of the insurance carriers in California have left the condo insurance market because when the claims happen, they are ugly.
Yeah.
And they can last for a long time, and then there's lawsuits, and there's a whole thing,
Is that because there's oftentimes like too many chefs in the kitchen? Like you're dealing with the HOA, and then you're dealing with the homeowner, and then dealing with the insurance company, and people are trying to point.
There's a lot of players.
Finger.
There's a lot of chefs in the kitchen.
Yeah.
There's a lot of players in the game, and it's really hard to determine exactly what happened, why it happened, and who's ultimately responsible for it.
Yeah.
And so that's the challenge of like when you buy a condo, that if there's a problem in said condo, be prepared. It takes time, and right, that's why you want to make sure that you have your own. Because if you don't have your own unit owner's policy, and you're the type of person who goes, oh well, the HO6 has walls in for me, right? Mm-hmm. And you forego your own condo insurance policy because your lender said it was okay, which was dumb to begin with, then you are now trying to file an insurance claim against the HOA.
Right.
And the HOA is protecting their asset,
the HOA.
not
right.
your ass.
Right.
They're protecting them. So their interest is not you. Their interest is them.
Right.
So they're going to do that. So to not have your own carrier and your own company involved to represent and fight on your behalf is kind of silly.
Yeah.
You should always have that.
Yeah. Agreed.
Yeah.
Agreed. What haven't I asked you that you would like to share with our viewers? I feel like we did a pretty comprehensive job. I mean, I know we can't be sitting here forever as much as I would love to because I have so much fun talking to you and we can talk about a whole bunch of things.
Yeah.
But is there anything that we didn't cover, or is there any final points that you would like to just reiterate?
Yeah, I mean, I'll say,
viewers?
I mean, like another like fun stat, and it plays really true to me because it's really personal to me, kind of a thing. To like shift gears, and we're gonna just talk very briefly, maybe if it's okay, about life insurance.
Yeah, let's do it.
But like, I lost my mom on her 64th birthday. And from cancer. And she said that she had a year, she had 2 months. And it was and even to this day, years later, it's still like, it's weird, and if you or if anyone watching has lost someone that they love, that's close to them, it's really hard. And especially if you have if you buy a home with with a spouse and you have kids. And so, last year I was lucky enough, or the year prior, I was lucky enough to also achieve the #1 agent to help clients in my company for life insurance.
Amazing.
And so it's one of those things where it's kind of like a lot of people don't like talking about it because it's kind of like morbid, whatever. I don't see it that way. I just see it as like adulting, kind of,
I mean, it's a reality.
It's a reality
of life, and oftentimes there's pain associated.
And you got to do it because
you have to plan for it.
You got to plan for it. And look, if you have a spouse or someone or a kid, and you have a mortgage that's $600,000 or $1 million or whatever the numbers are, and you don't have life insurance, you just got to do it. You got to bite the bullet, And most of the life insurance stuff that we write is term. It's very easy. It just means that if something happens to you, be it either cancer, COVID, a shark attack, car crash, whatever, if your ass is not here on the planet Earth, and that happens in the next 20 or 30 years, then that monies are paid out, and then you can pay off the house, right? The husband or wife can pay off the house, and everything in the estate is intact, kind of a thing. So I encourage people to contact me if they have questions about life insurance.
Sure,
we obviously do write other things too, people who have more assets, and they're like, hey Nick, what about infinite banking? Can you do that? Yes, that's a whole thing. There are a lot of people who want to dump in $100 grand or $200 grand into a policy and then borrow against it to go buy real estate. You could do that.
That's great.
Good
to know.
And what's dope is when you borrow that money and take it out of the policy to buy real estate, the money you borrow, you're still making interest on while you're borrowing it outside of the policy.
Oh, nice.
So that's awesome. And then once you're done with the flip or the real estate, you put that money back, you're good to go. And there's no taxes on that while you're borrowing because it's a loan and you can't tax loans.
A loan, right.
Right? Everyone knows that. So there's a lot of really cool things. So I would say, like, you know, it's just as a reminder that the most important thing to protect is not just the assets that you're acquiring, whatever it may be. The most important thing is your life. You know, and your family's lives and people around you.
And your loved ones.
And your loved ones. And just making sure that it's like you can check that off just to know, and the juice is worth the squeeze. It always is. And there are policies where I have sometimes people will say, well, Nick, I don't like the idea of, you know, spending money and then like burning it. I'm never going to get it back. There are life policies where at the end of 10 or 20 years, you can actually get back 80% of the money you paid in. Right? It's called a return of premium.
Okay.
And so there are options out there like that, you know, and so and that feels good because then like if you have like a 1-year-old, you know, and you want to in 20 years when they turn 21, you can take that money that you got back from your life policy, it doubles as a savings plan.
Right.
You know, so it's life that doubles as savings, and you can give that money to them if you want or invest it into something else. But I think that's also something that I think is really important for people to always, you know, keep at the forefront when they're buying property and stuff like that.
I'm so glad you brought that up. I mean, the world of insurance it's so vast, it's very complicated, and it's important to have somebody that you can trust who knows the ins and outs of it by your side. I thank you so much for being that person for me and for my clients. It's really special to have you here just because we have worked so closely with each other for so many years. So thank you so much for being here and sharing your expertise. And congratulations again on all of your success. I'm just so damn proud of you. I can't think of a more deserving
too. I mean, like
person.
you're about to reach a new milestone yourself, are you not?
Yes, 20.
Or should we not talk about it?
No, it's fine. We can say it. Age is just a number. No, it's this year, 2024, will be 20 years for me.
Amazing.
In real estate.
Amazing.
Yeah. It's really unbelievable how time flies. It's weird to say it, but I just feel so fortunate to be doing what I'm doing, and for as long as I've been doing it. Oh my God, 20 years. Since 2004. It went through market ups and downs. You know, the crazy peak, it was like the wild, wild west, and then the crash, and then just, you know, cutting my teeth during a time when a lot of people just left the business. It feels really good to still be here doing what I do. So
I mean, check the reviews. You got all the reviews, and they're all 5 stars.
Thank you.
And as we say, A players know and work with A players. So it's really nice to be in your company, and thank you for having me on this like awesome like little video podcast thing, and I look forward to having more. And and people can find me, and I'd love to have you on one of my podcasts too.
I would love to.
It's audio. Maybe we'll do a video one, but
cool.
I do have it. So if y'all want to find me, I'm on Instagram at Nick Ramirez Agent. And if you search me on Apple and Spotify, it's called The Insurance Rundown, and I talk about a lot of things that we talked about sometimes in more detail. Where if someone wants,
can go into way more detail on all this stuff. Like we're just going like very global now.
I'm like, if people ask me a question, I'm like, how much time you got? You know, but also too, instead of spending, because my time on the daily is limited, I might just say, hey, listen, here's a link. Check out this episode and stuff like that. So, but I really appreciate you thinking of me and having me here and talking about all this stuff. It's awesome.
Thank you. Hope you all enjoyed this and found some great value from it. Nick is just a wealth of information. Remember, you are investing in yourself, in your future, in your family's future. When you buy and invest in real estate, it is worth protecting. If you have any questions, anything that we can help you with, you know how to reach us. Thank you so much for tuning in. It is my pleasure and my honor to have you. And until next time, take care.